Good afternoon and welcome to our weekly education session for Wednesday the 12th of August 2015. Having a little bit of a think over the last couple of weeks about suitable topics for the education session, and given the market volatility and the vagaries of the market, it certainly creates a challenge for us as investors, as longer term traders as well, to manage our positions in accordance with our trading rules. So what I wanted to do today, the purpose of today's session, was just to recap on some of the stocks over the last couple of years that have put on significant gains, and whether there was any opportunity for us over the last couple of years to enter those particular trades, and if so, how might we have managed the outcomes of those particular trades. All right, so let's get underway. Obviously, first and foremost, a disclaimer: the content of today's education session or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, or particular needs. So please, before making an investing decision based on the general advice presented in today's webinar, please consider whether the advice is appropriate in light of your financial circumstances. Okay, so the agenda, as alluded to, I'm going to discuss a little bit about trade management. And can you actually follow the rules? We've really tried to make the rules as simple as possible, really clearing the air of a lot of uncertainty for a fairly large number of people. And the feedback thus far has been extremely positive. We've had some great reviews and lots of people writing in thanking us for simplifying things. So hopefully that's you, and hopefully you're getting some benefit out of these education sessions as well. The importance of cutting losses is really important, and you are going to have losses. It's something you can't avoid. I have them. Everybody I know has them, and it's just a matter of keeping those losses under control. So keeping them small, and on the other side of the ledger, making sure that you give your trades every opportunity to develop into something big. Now, there's no guarantee that that's going to happen, but you must create the environment in which that can occur if it is going to happen. And really an emphasis today on keeping things simple. So you don't want to be second guessing yourself when you're in a trade. You really want to have some very straightforward basic rules that you could teach to anybody. And from that point of view, be in a strong position to be able to replicate the process over and over and over again for many, many years. All right, so let's go through and perhaps have a look at some stocks that over the last 2 years have put on in excess of 100%. So what I wanted to do was go back in time and have a look. And the first example here is Blackmores. Now, Blackmores is a stock that we've got into recently in the watch list. The little vertical line here that I'm just scrolling out on, this line here is pretty much about 2 years ago, not quite to the day. So scanning back in time, so since 2 years ago, this stock has put on over 100%. So the question then becomes, well, was there any opportunities for this particular stock to present itself in our scans? And if so, how might have we entered it, and how might we have managed the trade? It was interesting, and part of the reason for doing this was on Monday, asking the audience, those members at the moment that were in stocks like SHV, Select Harvest, and CZZ, Capilano Honey as an example. And a number of people said, yes, I was in it, but I'm not anymore. And you've only got to have a look at a chart of Capilano Honey to ask the question, well, why aren't you still in it? What's the reason for getting out? What is it that's talking to you, telling you to get out of stocks when really our rule is really simple. Once price closes below that trailing 3 ATR, we exit. Now, there's certainly nothing the matter with taking some profits along the way. I think it's a good thing for your own psyche. It makes you feel better about your trading. Makes you feel a little bit more confident, and with that, I think it helps you to really stick to the rules. So I'm certainly not saying that you have to get all out right at the very end. You certainly can take some profits along the way. So here we are with Blackmores as an example. And the first time, from 2 years ago, you can see that, even relative strength-wise, the market certainly didn't like this stock. It was underperforming the market. And then over a period of time, our little histograms, which show the relative strength of the stock versus the benchmark, the ASX 200, they start to improve. First of all, they start to improve in the short term. Then over a period of time, the medium term, they start to pick up, and then the longer term. So our scans certainly aren't going to be picking up any stocks unless they are outperforming in all three time frames. Now, on top of that, even though a stock may come up in our scan, we still have to be diligent and have a look for previous long-term points of resistance, i.e. longer-term peaks in the past that might provide some sort of an obstacle. So if we just scroll out here a little bit, you'll see that from this particular date onwards, the only thing we need to worry about once it does come up on the scan is this old longer-term peak. So we know we have to give way to a long-term peak. There wasn't a valid setup through here. Now, the setups that I'm looking at today are purely exactly the same as what we are currently trading in the ETC Monday morning session. So that is being very diplomatic about the whole thing, or very concise is a better word about the whole thing, and making sure that our last trough is well above not the last peak, but the second from last peak. Okay, now there's lots of other opportunities entering a trade in different manners, and I'm not averse to people taking those on the provision that we've got all our three trends in alignment, that we've got all the relative strength conditions, and that we have at the very least rising troughs. So I'm not saying that there's only one way to trade, because there's not, but I certainly think there's one way to manage your trades, and that is using as simple manner as possible. So in this particular instance, being very, very conservative in terms of the price action, then BKL presented an opportunity, getting in around about the $45 level there back in beginning of this year, in actual fact, back on the 27th of February this year. So we actually had to wait a long time for a setup. So this stock, as I said, it was out of favour for quite a period of time. It started to become in favour. There was an opportunity. Now, getting in at 45.69 or thereabouts, the question then becomes, well, when do I get out? Well, a simple rule, you'll remember that initially on the setting of our initial protective stop, and I'll just put in a little line just to highlight where potentially that stop's going to be. So remember that your protective stop always has to be underneath that most recent medium-term trough. So let's just make that a little bit bigger so we can all see it as an example. And it's got to be at least 2 ATRs away. Okay, so at least 2 ATRs away. So we set our initial stop, our trade gets triggered, and we do nothing with the initial stop. That is just a soft stop, and we wait for the trailing 3 ATR to come up. And it does almost as soon as we get triggered. The price action, very strong, pulls the 3 ATR up. And it keeps pulling it up, and we keep getting a very strong price action, lots and lots of white candles. Now, along the way, we also have the price volume volatility signal going off a number of times, which, remember, goes off when the stock has experienced a significant stretch, if you like, in terms of its general sort of trading range. Typically, we get a big increase in volume, and that's typically associated with a fairly bearish type of candle. So the first opportunity for us to take some profits was, if we go back, if I can do this with a little bit of luck, our first opportunity was our first price volume volatility signal. So we'd only been in that for 56 days, and we'd had an increase of 31%. That's a pretty good return in a very short space of time. So certainly at that point, if you wanted to take half of your trade off the table and bank at least 31% on half of it, absolutely go for it. The next opportunity then, no sooner does that happen and price starts to move up again. And you're probably thinking at that point, oh, I should have stayed in with the whole lot. Again, you're never going to know. That's just hindsight. We get another price volume volatility signal, and again, if you wanted to take some profits at that point, if you hadn't taken profits previously, you could certainly do that along the way. But the big question is, should I still be in this trade? And the answer is a gleaming yes, because the price has not closed below our trailing 3 ATR. Okay, and that's a very important point. At the moment, as of last week, the price closed at 87.28. So far from your initial entry up to now, there has been no reason for you to exit the trade. And as a result, you're up over 90% as of last week. So just keeping things very, very simple. Did price close below the trailing 3 ATR? No, we're giving it lots of room to move around, and that's your job as an investor. All right, let your profits run and cut your losses short. Let's have a look at some other examples. Certex. So if we just scroll out a little bit and just put on a vertical line just so we know the date. So 2 years ago we were looking at August and around about the week of the 9th per se. So the first time that this would have come up on our charts is when all three time frames were showing us increased relative strength compared to the broader benchmark. So that's after this particular point here. And if we just sort of zoom out a little bit and see where we are in history as well, we've got some of these old long-term peaks as well. So even though we had some increasing relative strength through here, we've got to be mindful of these longer-term peaks. So the next opportunity where we're looking for the sort of price action where, you know, the last trough is certainly very close or at or above the second from last peak, is represents an opportunity through around about June of last year. As an example, there's certainly been other opportunities as well. Another opportunity through here where we get a short-term uptrend being confirmed and breaking out through around about that $24 level. So at this point in time, once the trade's been triggered, we get a number of price volume volatility signals. So in the space of 168 days, the stock's moved up 72%. I think at that point there, if you haven't taken some profit off the table, you've probably starting to wonder, you know, how far is this stock going to go? That's a very big move in about 6 months' time. So certainly prudent to take a little bit of money off the table, because the following week, you'll see here there was a huge pin bar that moved all the way back down. So the stock went from around about getting close to $30 all the way down to around 24. That's a pretty big change percentage-wise. Even that first price volume volatility signal that went off through here, now I'll just blow that up a little bit because you might not be able to see that. And I'll just fix up that last little bit of, there we go there. Price moved $5.60 from the entry level to when that first price volume volatility signal went off. 77 days, so about 2 months, and the stock's up 32%. Certainly, again, if you feel that that's a pretty good return in a short space of time, taking some of that profit off the table makes sense. So when do we get out of the trade? Well, the rule is when price closes below the trailing 3 ATR. Now, along the way, a couple of things happen. We get price volume volatility signal going off here, so it's another one. Then we had a second one. Then we had a third one. Now again, this profit line is not 100% accurate. It actually is based off the part of the candle that touches this blue line. So it's not 100% accurate. It just gives us a bit of a ballpark figure. So that particular level there is pretty close to where our candle closed for the price volume volatility signal. I might be able to move that down marginally. Let's be conservative and say it's there. That stock has still produced a gain of over 100%. So certainly if you haven't taken some profit along the way here, I think you really need to be asking yourself some questions along the way. Not taking it all off, but taking advantage of some of the profits you've made. Then a couple of weeks later on, I don't know whether you remember this, there was an announcement. Their product hadn't quite passed all the conditions that they had wanted to. So our rule is when price closes below the trailing 3 ATR, that's this line here, then we get out at market the following Monday. Now at market means that we're actually getting out at around about that point there, the low of the candle, so at the open on Monday, getting out at that price. So even with that, all that that gain that we made all the way, taking some profits, even at the very end, we still made, if you can see that there, 21%, just by plainly following our rules and getting out when price closed below the trailing 3 ATR. So I hope that's making sense, that by at least creating the environment for the trade to move, we're giving it the best possible chance. It's no guarantee, but we're never going to get these sorts of returns if we don't give the stocks an opportunity. So there's our marker 2 years ago. When did this stock first come up? Well, certainly we've got good relative strength on all three timeframes at this particular point. We've also got very strong price action as well. So being, again, very conservative about it and picking only the setups where we've got troughs well clear of the second from last peak, we have an entry through this level. No sooner does the trade trigger and it turns around, hits our initial 2 ATR protective stop, which remember has got to be at least 0.5% below our most recent medium-term trough. At that point, the stop loss on that then gets converted to a hard stop. Should the price go any lower, we get stopped out of the trade. The trade finds a little bit of support, turns around and moves up. Now again, there's a number of price volume volatility signals along the way, so suggesting, and haven't they worked well? The signal's going off and we're getting those retracements occurring afterwards. So again, it's a good opportunity that if you've got nice profit on the table, to put a little bit in the bank. So the first one that goes off there, let's just move him back, on that particular black candle there. So in 84 days, so not quite 3 months, you're up 29.21%. So nearly 30%. That's, excuse me, around about 10% a month. So that's certainly not anything to be sneezed at. From there, what happens? Well, price continues to retrace in the wrong direction as far as we're concerned, heading for our trailing 3 ATR. Now at that point, does price close below? Well, price certainly penetrates that trailing 3 ATR, but it doesn't close below. So from that point of view, what do? Well, there's nothing for us to do. We just stay in the trade and see what happens. Now, over the next few weeks, we get some fairly indecisive candles. At least they're white, so that's a positive change, and price moves up to all-time highs again. Another price volume volatility signal goes off. So if you haven't taken any profit in this trade yet, maybe that's a sign for you to take some. Price retraces. Has it closed below the 3 ATR? No, it hasn't. So at this point, fast forward, and if I can do this with a little bit of luck, it's a bit tricky, this the profit loss line. I'll see if I can move that to the end here. So a couple of weeks ago, this particular trade, VOC, was up 79% from the initial entry. So again, very simple rule. Certainly the stock hasn't done a lot in the last 6 months, but you know, it's basing out at this particular point in time. It's having a bit of a rest. It's done a lot of hard work through here, having a bit of a breather. You know, it now needs to start moving in an upwards direction. If not, and it comes back down and closes below our trailing 3 ATR, well, at least we've given it every opportunity. Next one, APE. So I'll just jump into my analysis manager here. Oops, that was the one there that I wanted. Right, so there's our date. Again, first thing we need to be looking for, when do we have certainly our relative strength, all in a positive direction? When are we clear of any longer term peaks along the way? So something that we could potentially be in from a trading point of view. Well, given that we've got a longer term peak there, I'll just put on that horizontal line rather than a trend line. I need to be clear of our longer term peak. So for the time being, that means even if there were any setups along here, I couldn't take them because I've got overhead resistance. So I need to break through that level. I need to see the strongest price action possible. And again, what I'm also looking for is the short-term uptrend being created and not breaking that last medium-term peak. So as an example through here, whilst we've got a trough which looks as though it's pretty close to either being at or above our second from last peak, we didn't get a short-term uptrend until we had a candle that passed that previous medium-term peak. So again, just making sure that we're being ultra conservative, and therefore waiting for a proper valid setup. So we get one. It actually occurred this year. So this is APE. It's still in the watch list, entering at $7.90. The last price is up near over $10. So that, in the space of 140 days, around about 5 months, is up 30%. And is there any reason not to be in this trade? No, absolutely not. Certainly a few up and down weeks through here, but the price is continuing to move in an upward direction. At this point, we only need a higher close, and that's going to pull our trailing 3 ATR line up as well. CTD, same sort of thing. Looking back a couple of years, when did we get the price action, the very conservative price action, in which we could place a trade? Well, we had an opportunity in October of last year. Excuse me. In October of last year, we had a short-term uptrend confirmed. Remember, our initial ATR has to be at least initial stop has to be at least 2 ATRs away, and it needs to be below our most recent medium-term trough. From that point of view, once the trade triggered, it presented also some further opportunities along the way to take some profits. An example up here, the stock had already increased nearly 62% at that level. The first ones that went off gave us a couple of opportunities through here, and I'll blow that up a little bit just so you can see. It's hiding behind the candles, etc. Let me see. Oops, our little lines through there has moved. As I said, you've got to be careful of that. So entering at that particular level, seeing the dotted line, the move was $2, nearly $2.40, up to that first price volume volatility level there, and that represented a move of 31%. So an opportunity in a little over a month and a half, you've made 30%. Putting half of that in your pocket, sure, I don't have a problem with that. Do you need to get out? Absolutely not. I'd be disappointed at that point if you took half off the table and then saw a big black candle and jumped out down here for the other half, because that's not following your rules. Okay, we've got to keep it as simple as possible. When price closes below, well, when does price close below? We get another couple of price volume volatility signals. We get one up here as well. By this stage, we're up nearly 62%. So if we've banked the first one down here where we made 30, if you haven't banked that and you've made 60, well, that's great. But eventually all good things come to an end, and you'll see over here on this particular candle that price closed below the trailing 3 ATR. So that just means that we need to get out. Now the profit line doesn't quite work exactly to the end there, so let's take the worst case scenario in this case and see what sort of a return we got. Well, the move was still $2.23. I'm not too sure whether we're going to be able to see that, and it represents a 29% return. So if you've made 30% on the first half and you made 30% on the second half, well, you've made 30% overall. If you happen to make 60% on the first half and 30 on the second half, well, then you've made 45 overall. So again, certainly good results on trades that have performed really strongly and have been quite simple to manage. Question from David: if we take profit on half at the PVV, what do we then do when the next PVV appears? Well, good question. So certainly at any point in time, once you've taken some profits off the table, this is what I do with my own trading. I'm always looking for an opportunity to re-enter the trade. So from that point of view, as soon as I've got that higher trough forming, and there's an opportunity to scale back in or add that other half back in, then I'm always looking for that. So any type of strength that I'm getting in the management of the trade or the progression of the trade, then I think that's a good opportunity to put some of that capital back in. All right, the other alternative there is, if you've got another one, depending on how much profit you've got in there, is just to keep the existing half R still in there. So again, it's going to depend a little bit on how much money you're making along the way, how close those price volume volatility signals are together. If they're very close and at the same level, then I would be inclined to ignore that second one completely. Again, you've got your trailing 3 ATR stop, and that's there for the specific purpose of giving it lots of room to move. Good question. Select Harvest was another example of a stock, and let's have a look. The first time that this came into the ETC world through price action and relative strength, etc. 2 years ago, the first tradable opportunity after that, you'll see that if I just zoom in there a little bit, hopefully you can all see that we had a short-term downtrend, then we had a couple of candles confirming our short-term uptrend being pipped in. No sooner are we triggered in and price has a retracement. So again, making sure that your initial protective stop is at least 2 ATRs away and also below your last medium-term trough. It's a soft stop. 3 ATR line when we're first summing up the trade is way down here. A 2 ATR, making sure that we're below the last medium-term trough, at least by 0.5% at the very minimum, and making sure that you are at least a minimum of 2 ATRs away. So the first opportunity there that occurs, we get triggered in, price retraces before recovering. Now you'll notice at the same time that as price moves up and triggers us in, that at the same time it pulls that 3 ATR line up as well. And eventually, once it gets a little bit more momentum occurring, it starts to then pull that 3 ATR line up again and again. Lots and lots of price volume volatility signals, isn't there, along the way? So again, if you're getting these price volume volatility signals and you haven't made much in the trade, then I would just ignore them. You've got to have something that is giving you a reasonable return for your initial reward as well. There's no point risking 10, 12% and having a price volume volatility signal go off and give you a result of 8% profit, because automatically you have just risked more than what you rewarded yourself, and that's one quick way to blow up your account. So you certainly don't want to be doing that. So any of these opportunities along the way, you could take some profit off along the at those points in time. Certainly not suggesting that you would have waited 1, 2, 3, 4, 5, 6, 7 price volume volatility signals. I think you'd be pretty brave if you were waiting and waiting and waiting, because you're never too sure when the price volume volatility signal goes off that it's not going to be the last one and you get a big move back the other way. So certainly not suggesting for a minute that you would get out at at this very high level, the last price volume volatility signal. That's a 60% return, but certainly plenty of opportunities through here to be picking up 30 or 40% in a fairly quick period of time. So price then closes below. So on the second half that we haven't, it's still in the trade, we get out at a very low level at around about $5.20. Compared to where we first entered, we're still making money on that second half as well. As time goes by, another opportunity presents itself, and it's basically when we get past this longer term peak. Again, price moves past, retraces. We've got to have a protective stop below our most recent trough outside of 2 ATRs, and this just continues to move onwards and upwards. That's Select Harvest, which up to this point in time is up 45% in just under 100 days. So a great return, and again, in comparison to what the rest of our market's doing, this is a really strong stock. And if I was to ask anybody who was in this or who had traded this, I would expect them to say that they are still in it because the price hasn't closed below the trailing 3 ATR. Well, I think we're getting the gist of things there. Hansen Technologies is another one. I don't want to go into too much detail. I think we're all sort of getting the message, but the important aspect of your trade management is just to be patient. allow the trade to unfold along the way, because you're never going to get returns of 66% in 2/3 of the year if you go worrying about movements up and down. You know, this concept of lower peaks forming and ram cramming and jamming, well, all of a sudden if you do that, then you're out at $2.30 and you've missed out on another 70 cents upward side movement. So let's just keep it simple, and when you do have an opportunity to take some profits off the table, and the level of profit, again, this is a discretionary part, but certainly wanting to be making sure that what you are taking off is at least what your initial risk is. Okay, and then just chilling out and just let the thing have its reign. Okay, now it's not always going to work in the perfect scenario, and that's just part of investing along the way. These are just some from the US. I just wanted to pluck out. There's our date. When was the first time that we could have traded this? Well, it wasn't until about the middle of last year, 2014, when a really clear-cut, very conservative opportunity presented itself. Went sideways for a little while after triggering in. There's our first price volume volatility signal. I'd be ignoring that one because you really haven't made that much in terms of your initial risk. At that point, we get a candle that closes. Does it close below? Let's go and have a look. The close there, I might just get rid of our little line there, a little profit loss line. The close there was $53. The little green number there, that's our trailing stop line. That's $52.90. So price actually closed above our trailing 3 ATR. It came very close. And during the course of the week, the low was $52.40. $52.40 was the low, which was below our trailing 3 ATR. Remember, it's the close of the candle, not the low, the close. So I would expect that a number of people, having seen that and being in it from all the way down here, probably would have closed at this point saying, oh no, it's going to give back. I'm going to give back everything that I've made through here. I'd better get out now. And as a result, they've missed out on a move from around about $53 through to, it's at the moment, it's at $68. So that's another $15 that they've just left on the table through not following their rules. Let's put our analysis on this one. This was in the portfolio last year. So a couple of opportunities from 2 years ago which we could have traded, being very conservative. A trade through this particular level where our trough is certainly above our second from last peak. Eventually getting stopped out, not without some opportunities along the way to take some profits. Let's just zoom in a little bit so we can see that a little bit better. As entry points, those price volume volatility signals going off. As an example, just an approximation. At that point, making 27% in under 2 months. Not a bad profit if you wanted to take some off then. I don't have any problems with that, as long as it's more than what you initially risked on the trade. Eventually stopping out when price closes below our trailing 3 ATR. And if we just move our value line across and have a look on any of those, the close there, 54.36. The ATR trailing stop, 54.52. So certainly a close below there. Let's go back one more candle. The close, 54.88. The ATR trailing stop, 54.52. So at that point there, we're still in. The following week, we get stopped out. So close at 54.36 after an entry past our previous high of 52.31. You've still picked up about around $14 on that particular trade. Next trading opportunity where we get a trough clearly above the second from last peak. And this is sketches along the way. Initial stop, and this stock has just continued to go up and up and up. So it's the sort of thing that if you were in at around about $70 odd through our breakout trade, $70 odd, the stock is now 153, It's put on over 100%. There is no reason why you should be out of this trade. There's been no price volume volatility signals along the way. However, along the way, if you so feel that through this little period where it's going a little bit sideways and you look back and think, well, I got in at 70, the price at the moment's 111, I've made $40 on my $70 stock. Do you think it would be okay if I took some of that off the table? Sure, why not? You've made many multiples of your initial risk. I think that makes a bit of sense. It's good for your mindset. But as long as you continue to stay in the trade because price hasn't closed below that trailing 3 ATR. Hopefully that's making sense. So it needs to be simple. If it's simple, we'll do it. If it's complex and convoluted, you're going to find every reason under the sun not to stay in the trade. First opportunity for AAP after last year of August this time last year was when we start to get increasing relative strength. So relative strength all above 0 is the first time that this would have started coming up on the scans. All these little green dots just showing where we've got short-term uptrends as well. An opportunity through $103.22. Along the way, are there any price volume volatility signals? Let's pop that on and see. We've got a couple. So certainly a number of opportunities to take some profit off the table along the way. Should I still be in this trade? Absolutely. Because price hasn't closed below its trailing 3 ATR. Okay, there's nothing scientific about this. There's nothing that's going to make you have to crunch numbers and do all of those sorts of things. It's black and white. When price closes below your trailing 3 ATR, it's time to leave. Conversely, if you don't like the concept of waiting for a close below, you can choose to get out when price hits the trailing 3 ATR. Okay, you can do that also. That sometimes has the benefit of getting you out sooner. However, as we've seen in some other trade setups, it has the drawback of price coming down, hitting a trailing 3 ATR, only to turn around and move back up to all-time highs. Okay, so I guess the really clear message is just be patient with your trades, let them evolve. We have no control of what's going to happen in the market. You've chosen to be exposing yourself to the markets. You understand risk management, position sizing, they're two absolute givens. The hardest part about making money in the markets is just managing your trades. It doesn't really matter that much if you muck up your entries. The important thing is that you must manage your trades appropriately and in a fashion that's easy to do, it's repeatable, and that is at least going to allow trades like this to become part of your portfolio. A lot of people ask, how do I find trades like this? Well, that's the wrong question. How do you exit trades like this that you get into? You exit when price closes below the trailing 3 ATR. That's the answer. Right, folks, I'm going to call it an afternoon. Again, really important, your trade management. Can you follow the rules? I think the rules are pretty simple. You just need to follow them. Cut your losses early. All right, so keep your stops. Make sure you're understanding where to place your initial stops. And if price happens to trigger those particular stop losses, then you need to get out. Don't hang on hoping that things are going to turn around. Let your profits run and keep it simple. Have we got any questions before we wrap up? Any questions? If not, that's okay. If you think of something later on, don't forget to just request a coaching call and we'll jump on the phones and get in touch. Right, folks, good luck with that. Again, keep it simple and keep it consistent, and we'll catch up with you later on in the week. Bye for now.